Everyone loves the idea of taking over a 2.5% VA loan in a 6% market. Almost no one talks about the cash gap, the entitlement trap, and the timeline that can kill the deal. I'm Cathy Sabater, mortgage strategist and proud veteran. Today, I'm breaking down how VA loan assumptions really work, the 3 biggest traps, and the 5-step strategy you need before you sign a contract. Let's start with trap number 1. Trap number 1 is the equity gap. The first thing you need to understand is this. You are not assuming the home value. You are assuming the seller's current loan balance. That sounds great when the rate is 2.5% or 3%. Here is where buyers get blindsided. Let's say a veteran bought a home in 2021 for $400,000 at 3%. Today, that same home could potentially be worth $550,000. That means there could be a $150,000 gap between the loan balance that you are assuming and the price the seller expects. You as a buyer have to cover that gap. That is the part people do not talk about enough. You usually cannot stack another VA loan behind it on the same property. So if there's a large gap, you as the buyer need cash, a HELoan, bridge financing, or another approved second lien strategy to make the deal work. This is why so many buyers get excited about the low rate and then realize they don't have enough funds to actually close. The strategy is not just chasing the low rate. The strategy is working and solving the gap before you fall in love with the home. Trap number 2, the entitlement trap. Now let's talk to the seller. If you are a veteran with a low rate VA loan, your home may be one of the most attractive listings on the market. You have to protect your VA entitlement. Here's the part a lot of sellers miss. A non-veteran can assume your VA loan. That means someone who never served in the military can potentially take over the low rate. If that happens, your entitlement can stay tied up in that property until that loan is paid off. That becomes a major problem if you plan to use your VA benefit again on your next home. You may think you can move on and buy again with zero down, only to find out your entitlement is still locked in the house you just sold. The best solution is a substitution of entitlement. That means another eligible veteran assumes the loan and substitutes their entitlement for yours. If you are selling, do not agree to an assumption without a strategy for your next home purchase. Trap number 3, ghost timeline. This is the time gap. A normal home sale might close in 14 to 30 days. A VA assumption can take up to 60, 90, 120 days plus. Why? Because this is not moving through the normal purchase lender process. It goes through the seller's servicer. This is the company collecting the monthly payment. Servicers are not like active mortgage companies handling purchase transactions every day. They don't move with the same urgency. They are definitely not rushing because your contract says 30 days. So if you set the wrong escrow timeline, the buyer gets frustrated, the seller gets frustrated, and the whole deal can start falling apart. That is why you have to audit the services process to set expectations. Now, let's talk about how you can actually win with a VA assumption. Here is the 5-step strategy. Strategy number 1, audit the entitlement. You need to look at both sides right now. Is this a veteran to veteran assumption? Is there going to be a substitution of entitlement? If not, what is the seller's plan for their next purchase? You want those answers early, not halfway through escrow. Strategy number 2, solve the equity gap. Check the current loan balance, compare it to the market value and the contract price. If there is a gap, figure out how it will be covered immediately. Do not wait until later in the process to discover you have a financing problem. Strategy number 3, call the servicer first. Before your contract is finalized, find out what documents they require, how they process assumptions, where the application goes, and how long it takes to close. Build your contract timeline around reality, not hope. Strategy number 4, get the release of liability. If you are a veteran seller, this is non-negotiable. You want formal confirmation that you are released from liability, because if the buyer misses payments later, you don't want that risk tied back to you. Protect your credit and protect your benefit. Strategy number 5, build a backup plan. Assumptions can be powerful, but they are slow and servicer dependent. So you need a backup financing strategy in case the timeline drags, the paperwork stalls, or the assumption no longer makes sense. That backup plan protects the deal. Here's the bottom line. A VA loan assumption can be one of the best opportunities in a high rate market. This is a strategy play. If you do not structure the entitlement, equity gap, and timeline correctly, that great deal can turn into a very expensive mistake. Emotion kills deals. Math saves them. If you want help reviewing a VA assumption, comment VA below and I'll help you map out the numbers and the next step. I'm Cathy Sabater. Thank you for your service, and I'll see you in the next one.